Hello, this is John Smallwood, Senior Wealth Advisor at Smallwood Wealth Management, located in Red Bank, New Jersey. Today, we're going to continue on the conversation of the 19 sources of retirement. And when we talk about this, what we're talking about is having a future where you have multiple sources of retirement income. Many financial plans have one or two sources, and when one dries up, there's not a lot of defense in the plan. And I think what we're trying to accomplish is that if you understand what the sources are and you begin to accumulate assets in those areas, you build a more potentially durable financial strategy as the world and the economy evolves. And I think as you think about the past and you think about the future, everything that you know about the past is different today when you start thinking about sources of retirement income. Some of the stories are the same. People have failed to accumulate enough money to maintain their standard of living. There's sort of universal things. And I believe it's because of financial pressure. And when you talk about financial pressure, we're talking about taxes, transaction costs, fees, planned obsolescence, technological change, overspending, just a lot of market volatility, just a lot of things out there that are putting pressure, college costs, long-term care costs, disability, underemployment. We can go on. We've got videos, we've got content on this, but what we want to talk about in the 19 sources of retirement income is when you build a financial strategy, you want to have these different sources of retirement income. And if you think back to, and this is kind of a concept, like where does interest come from? What are the types of interest? And I want to hit number 3 on the guide where we're talking about interest, because I think this will really tell a story that you need to understand. And I say this from the perspective of everything that we know in financial planning based upon the past, the present, and what may or may not happen in the future is going to impact the results of the strategy that you have in play. So when we think about interest, where does interest come from? What are the types of interest? How do we get interest? Okay. Fundamentally, if you really delve into the bottom line is, in order to get interest, you're going to lend your money to something, to a bank, to a corporation, to a government, to an individual, to a business, to something. And in return, you're going to receive interest for the use of your money. And a bank is a perfect example to understand this. When you think about, I can put money in a CD, I can put money in a money market account. And in essence, if it's at a bank or a savings account at a bank, I'm lending the bank my money. In return, they're going to pay me interest, and that interest is going to be something that's going to change. I could lend it to a corporation in the form of a bond. Okay, so when I lend money to a corporation, I buy XYZ corporate bonds. There's all different types of credit quality. We're not going to get into that today. The higher the credit quality, the lower the interest. The lower the credit quality, the higher the interest, if you want to, dig a little deeper there. But the idea is I'm lending money in the form of a bond. Let's say it's a $10,000 bond. It's a 10-year bond, and we're going to get 5% interest. I'm going to lend them the $10,000. I'm going to get my 5% interest every single year. And at the end of 10 years, that corporation and or government is going to give me my money back. In a CD, it's a very similar type of a structure. I'm lending the money to the bank. I give them $100,000. They give me 1%. Let's just use that as an example. And at the end of the year, it matures, and I have the option. I can roll it back in, or I can move it somewhere else, if I'm happy with the amount of interest. Now, when you think about mortgage interest, right? And you could lend money to your children and they could pay you interest. You could be selling a piece of property and holding back a mortgage, and they're going to be paying you interest. So interest comes from a lot of different sources in the plan. Interest rates are constantly changing. We happen to be in one of the lowest, protracted, lowest interest rate environments that we've been in. I'm celebrating my 30th year this year in the career of a financial advisor. I began in 89 on a college contract, full-time in 1990. And what was really interesting to me, and all through the 80s, interest rates were 16, 15, 18%. You could buy bonds that were paying you an interest of 15, 16%. You could get a CD that was 14, 15, 16%. So when you thought about financial planning, it was relatively easy. And if we frame this in the concept of $1 million and the value of $1 million, if I had $1 million in the bank and I had a 10% interest, I had $100,000 worth of interest income. That was pretty simplistic. That was an easy way to plan your future. But you got to think about it from where would I be 5 years out, 10 years out, 20 years out, 30 years out. As the interest rate started to decline, if I had all my eggs in just interest, in the bank or in a bond, as my bonds matured and my CDs matured, each time that was happening for the last 30 years, I've been pretty much getting a trend of lower and lower interest. So the value, if I have a 5% CD 10 years later, that $1 million account's now only producing $50,000 worth of interest. So my purchasing power is getting, destroyed, or my principal is getting eaten up to maintain the same amount of income. And I think what's frightening is I always joke with people. I see some of the greatest spreadsheets. People come in, their spreadsheets are detailed, they have assumptions in the spreadsheet, and they have this interest rate factor or rate of return that they're going to earn on their money. And everything's perfect because they're making 5 or 6%, and it's all perfect. It's usually missing many, many variables. It's missing volatility, it's missing taxation, planned obsolescence, technological change, all those things. But the idea is that if I sat down in 1990 and I made a financial strategy and I kind of just kept it going, and I said, okay, I need to have $1 million by the time 30 years rolls around in the bank. And right now, 30 years ago, let's say I had nothing, and I can make 10% in my CD, just as an example. How much money would I need to put away per year to get there, right? So that $1 million future value, zero value, present value, 30 years at 10% interest, what we'd find is that if I put away $66,079.25 at 10% interest, 30 years later, I'd have $1 million in the bank. If my interest rates collapsed and I only received 5%, I'd only have $403,000. I would have fallen short of my goals, not impacting financial pressure. Even though the volatility is there would be taxation, etc. So when we think about assets are going to produce interest, we have to look at a couple different factors in the plan. What I've contended, what we as a firm have contended in all of the training and everything that we've done is interest is a powerful tool. I didn't even want to bring it up, the seventh wonder of the world, but who knows if whatever. But you all know what I'm talking about. But compound interest is a powerful tool to accumulate wealth. But the erosion principles, the financial pressure, the compounding of the taxation, the compounding of fees potentially, the compounding of financial fees and things like that are eroding this potential of the capital. And that's not really being factored into anybody's plan. But what's interesting is, let's say that I have interest income in my plan and it's a high interest rate. That is a good thing. The tax is going to reduce it because it's going to be taxed. When you go to your tax return, okay, you're looking at a couple of things. And in the new 1040s, this is line 2B is going to be taxable interest, okay? That taxable interest is going to be, in essence, taxed above your wages and your salary. So it's put on top of that. And this income is being taxed at your marginal bracket or your highest bracket, right? So when you think about it, you have an effective tax bracket and you have a marginal tax bracket. The difference between the effective tax bracket is that the effective is more of the average. Overall, how much tax are you paying as a percentage, where the marginal bracket is where are these last dollars being taxed, at what bracket? So if my income is above $600,000, 600, I think 650, and that interest is going to be taxed at the 37% bracket. And you're going to owe tax based on that. Plus, if you live in a state where they're taxing your interest income, you also have to pay state and local taxes on that. Now, there are strategies to help minimize that taxation. The purpose of the podcast today is not to talk about those things, but to get you thinking strategically about having interest in my plan from multiple different sources makes a tremendous amount of sense. But I also need to be flexible, because if you use my example of, $1 million in the bank in the late 80s producing, 8 to 9 to 10% interest, if that is the sole asset in my plan, and I look around and say, why would I put any money elsewhere at any point in time? Because that has very little risk and I can make 8 or 9%. Well, the risk was that the interest rates collapsed. You didn't know that was going to happen, right? So, and as it occurred, it was a slow reduction in income and purchasing power. If you factor in inflation and all the other eroding factors, 30 years later, that money's probably not even in the bank still if you needed that $100,000 to maintain the income. And that's the financial pressure. So the idea of having 19 sources of retirement income, not everybody's going to have every single one of these, but the more of these that I have in my plan, the more thinking I do about where am I putting money? And once I put that money there, what is my strategy? How do I minimize the fees? How do I minimize taxation? How do I minimize the impact of volatility? How do I minimize the interest rate risk as interest rates change? That's strategy, and that is part of our planning process. One of the things that I offer all of the time to anybody listening, to existing clients, to people that have just found us on the podcast, is that understanding where you are right now, basically getting clear with all your family makeup, your future liabilities and current obligations and current liabilities, your business, your income sources, your taxes, your savings rate, your debt structures, your lifestyle, where your assets are, understanding all of and how well it's protected, understanding all of these things is the most important part in creating a long-term successful financial strategy. What I find is that people want a magic bullet, a solution to something, and they're saying, let me throw some money at this, and because that has a great rate of return, rather than doing a big picture plan. We think you should do a big picture plan, and you should be putting together the assets together so that you're accumulating as many of the 19 sources of retirement income as you can, and being able to move money around and be flexible over the time of your accumulation, your distribution, and your passing of the money off. Now, interest income can be held in many different formats, right? So you can have an IRA invested in a bank account, a CD, giving you interest. That is not taxable until it is pulled out. There's a couple of different things that you can achieve from the standpoint of, tax deferral. There's different ways to get that done. And I think it's, when you're building this plan, understanding how your money is allocated, where the money is, how it's currently being taxed. Can I pick up multiple sources of interest income so that when that income is derived and it is sent out to me, I'm either paying taxes on it currently, or I'm deferring that tax, or I have some strategic methodology to remove that money from an account where I'm not paying. Maybe I'm getting some principal, and we'll talk about that as we go forward. But I really want you to take advantage of the conversation and getting clear as to where you are. I'm 51 years old. I have 4 kids. I've got some colleges done. I have weddings coming. I have business obligations. I have things that I want to do, and organizing that in a way to understand, okay, here's where I am. Here's my sources of income currently. Where do I need to put that money so that I minimize my tax over the accumulation phase? I set it up so that I can get my money out in the most tax efficient manner that I possibly can. I reduce my risk. I reduce my fees and my costs through my strategy. I develop better income sources for retirement and still pass the maximum to my family. These are things that you need to constantly refresh and rethink your entire financial strategy in a way that, I don't want to say it that way, but you're not clueless about where you're going. And I think you really need to be, I always joke with a lot of clients, and I say this all the time, is the next 15 years are the most important 15 years that we have, regardless of what stage of wealth management you are. You could be retired. You could be, 30 years old and just starting, you're out of med school and you're just finally starting. You could be 22 years old, just starting. You could be 40, wherever you are, the next 15 years, what you do today and over the next 15 years really sets you up in the right way and sets your wealth up the right way. The sooner you get started, the better off you're going to be. I truly appreciate you listening to this. Hopefully you found it of value. Please subscribe to the podcast on iTunes or wherever you like to get your podcast. Share it with people that you think it could be of value, and take advantage of our offers by going to smallwoodassociates.com. There's my 5 Ways Your Wealth's Under Attack book. There's the 19 sources of retirement income that you can pick up, and make a phone call and set up a one-on-one consultation over the phone, 30 minutes. We call it the Wealth Curve Pressure Identifier Conversation. It's a free, no obligation call. At the end of the call, you'll know whether or not what we do is the right thing. Thank you. Have a great day. Welcome to the end of the video. Smallwood Wealth Management is an investment advisor representative. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented for this educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as a receipt of or substitute for personalized advice from Smallwood Wealth Management or from any other investment professional, and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or an accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Thank you for listening.